Hello, my name is Mike Smith. I'm the president and founder of T&K Futures and Options Incorporated. And today's video lesson is about the lean hog market. But before we get started, let me go ahead and cover the risk disclosure here. Futures and options investing carries significant risk of loss and is not suitable for some investors. Past performance is not indicative of future results, and you should only use risk capital for these types of investments. Okay. Over the 20 years or so that I've been a commodity trader, I've heard a lot of questions from investors, and what we're going to do is cover the 5 most popular questions, let's call it, that I receive as they pertain to the lean hog market. So the first question I typically hear is, how do futures contracts and margin work? Well, margin is a good faith deposit that you have to have in your account in order to go long or short a futures contract. The exchanges are the ones that set those limits. During times of high volatility, they'll quite often raise the margin requirements to try to slow down the volatility a little bit. And when times are slow, quite often they'll lower the margin rates that are required to try to stimulate more speculation, because they make money the more trades that happen. So they're the ones that set it, but I want to give you an example on how it works. Okay, let's say you want to get long 1 April lean hog contract, and hypothetically you opened your account with $50,000. And here's the margin today. It's $1,320. So that's your initial margin you need for just one lean hog contract. Okay, so that money goes on the sidelines, and this is what you have left over. You have $48,680 in available equity to leave in the account in case the market moves against you, to get more contracts, to buy options, whatever it is you're looking to do. That's what you'd have left, because the margin money goes on the side. Okay, lean hogs. Lean hogs is a 40,000 pound contract. Every 1 penny move is equal to $400. Okay, so let's go ahead and give a profit and loss example. You're long 1 April lean hog at $1. It's not $1, it's 80 something today, but just for easy math. Okay, so let's say you get long this one contract at $1, and the market goes your way by 4 cents. Well, that's a $1,600 move. That's 4 times 400. That's a $1,600 move. Pretty good day for you. Let's do the opposite now. Let's say you get in at $1 and the market comes down to 96 cents. Well, now it's a bad day for you. You just lost $1,600. And that's how the profit and loss works with a futures contract. I don't know if you can read this or not, but that says infinity risk. No one's ever lost infinity, but the bottom line is, if you're short a contract, theoretically speaking, there's no end to how high whole numbers can go. That's why theoretically it's unlimited risk to the upside. To the downside, your risk is limited to 0, because the numbers can't go lower than 0 for a commodity like this. I doubt that lean hogs will ever be worthless. I know I certainly, it's my favorite meat. But so that's not very realistic either. So the bottom line is, theoretically speaking, unlimited to the upside, finite, 0 to the downside. Not very realistic that either one of those two things would happen. But what you should take out of this is that these markets are extremely risky, and you have to manage your risk if you're going to be involved in risky markets. And that's what the next question typically is how do you manage the risk in such a risky market like the futures? And I don't know if this shows up, but it says sell stop right there. So a sell stop is an order you can put in below the market if you're long to limit your losses. So it turns into a market order once it's triggered. And I'm going to show you how that works. So you're long at $1, the market's going against you, it's moving against you, it's moving against you, coming down, in 98, 97, 96, it trades through 96. Well, this sell stop order gets triggered and turns into a market order. Now, what that means is you're going to get the next available price. And if you can read it, it says you're risking 1600-ish. So we set our parameters, we want to risk 1600. There's an ish next to it. And the reason I said ish is because you don't know what that next available price is going to be. In this example, it could be 96.05. It could be 95.90. Might be right at your 96. You just don't know, and that's why it says ish. But you know, you certainly want to use stop orders or whatever risk management tools you're going to use when you're trading futures. But that's the one I suggest. That's the one I use. Okay. The next question I typically get is, what's a call option? Well, a call gives the purchaser the right but not the obligation to buy the underlying futures contract for a specific time frame, in this case April, at a specific price. And this is 104. So let's say you wanted to buy this guy right here, the 104 strike price, and it cost you 3 cents. Okay, well, it's 3 cents times 400, so the premium cost of that option was $1,200. All right, so you buy this option when the market's at $1, boom, goes your way by $1,600. Well, you're not going to catch that entire move. Options only catch a percentage of what the underlying futures market does. And I made the, all this stuff's made up, but I made up this delta factor too. This is what you care about when you want to figure out how much your option is going to increase or decrease based on the underlying market. Okay, delta factor. I made this up, 25%. There's an issue next to that too, and I'll explain that in a second. So if you bought this option and it had a 25% delta, and the market moved in the futures $1,600 to the good, well, your option's only going to catch, hypothetically, 25%, which is $400. So you paid $1,200 for it, now it's worth $1,600, the premium is, in this hypothetical example. Conversely, let's say the market went against you by $1,600. Well, you're going to lose $400 or 25%. So now your premium's down to $800. So that's how the delta factor works. It says ish there because the fact of the matter is it's changing constantly. As the market's moving, the delta factor's changing too. There's other Greeks that you need to know about. It's the theta is time decay. These are wasting assets. You have your vega, which is your implied volatility. These are all other factors involved in option pricing. But this is the one that's going to tell you how much your option is going to move in relation to the underlying futures contract. The next question I typically get is, what is a put option? Well, a put is the opposite of a call. It's the right but not the obligation to sell the underlying futures contract. So just like that's the right but not the obligation to buy, this one's sell at a specific time period. This is April at a specific price, which is 98 cents. In this example. Limited risk. Okay. When you purchase an option, your extreme worst case scenario as far as your risk is concerned is it expiring worthless. And so you can go to zero. So in other words, if you paid $1,200, your worst case scenario is losing that $1,200 plus whatever commissions and fees you paid. So that's your extreme worst case scenario. Your risk is finite when you purchase a call or a put option. Let's see. Yeah, that's about it for today. If you have any questions, you can go to tkfutures.com. Give me a call. My name again is Mike Smith. My contact information is right there. I wrote a book about options called The No Nonsense Guide to Buying and Selling Options. You can get that on Amazon. It's all about options. It doesn't cover futures at all, though. So if you're a futures trader, buy the book. Also, you might want to use one of our free practice accounts. Gives you $50,000 in virtual equity to trade with. I would suggest doing that before you risk any real money. But it gets you used to the platform and how to trade and things like that. But I think that's about it for today. So I hope you learned something, and have a nice day. Bye-bye.